of the plot line. And throughout 2016, like the saying, the more you read, the more you know. The more you watch, the more CFP-CE credits you'll earn. You can get 8 credits, 1 for each month. Today's storyteller reads a lot, constantly monitoring the insurance and financial services industry to ensure your clients are getting the most up-to-date recommendations. He joined LLIS in 2003 with his CFP and MBA and has been writing the LLIS story as president and CEO since 2013. And now, Mark Maurer.
Thank you, Claudia. I appreciate it as always. Thank you to all of you for tuning in. It's a hot and balmy September here in Tampa, Florida. Perfect time to talk about life insurance, September being Life Insurance Awareness Month. And most of your clients and even, you may not like the idea of talking about death. So how do we take a topic that no one wants to talk about and make it a little bit more fun? Well, we use The Simpsons. So in honor of the 28th season of The Simpsons beginning this month and being a big fan myself, I chose to make this presentation about Homer and his family. Just as The Simpsons have gone through their own evolution through the series, regular families like us do too, which is why the need for life insurance is so important. But, like any good speaker, I'm going to start off with a joke. So, did you hear the one about when the insurance agent and the IRS auditor walked into a bar? Everybody left. Now, it's a joke, but you know what? In actuality, that's probably exactly what would happen, because nobody wants to talk about these things. And while I am not going to really talk about taxes, I am going to talk about life insurance. I said, why does nobody like to talk about these things? I think it's sometimes we don't like to talk about things that we can't change. And as Ben Franklin said, in this world, nothing can be said as certain except death and taxes. But it's important to talk to your clients about taxes. I'm sure you do it. And it's important to talk to your clients about life insurance. And September, being Life Insurance Awareness Month, is a perfect time to do it. So we're going to touch on a number of different things that you can talk about with your clients. Why life insurance? Or how much does my client need? They want to insure their family. How about having life insurance only through work? Maybe I should get some myself outside of my work. Converting insurance. Converting term insurance to permanent insurance. And we're going to talk about permanent insurance in general as well. And I'm going to touch on the claims process of the life insurance, because we do a lot with the underwriting and having a policy, and we may have that term policy for 20 years, or we may have a permanent policy for 30 or 40 years. At some point, there may be a claim paid on that life insurance policy. So it will have done exactly what it was supposed to do. So we're going to just touch a little bit on how that works. But first, let's talk about the why. Why do I have life insurance? Why do you have life insurance? Why do we talk about it with our clients? We have it ourselves. Because we worry about our families. We can't protect against the loss any more than health insurance keeps us from getting cancer, or homeowners insurance keeps our house from burning down. But the insurance, in the case of death, provides money. And money can't solve all problems. Of course, it doesn't make the sadness go away. It doesn't make the loss any less real, but it provides money to pay for medical expenses like Homer may be incurring right now, to replace lost income for a family. So there's lots of different things, but it protects against the financial loss. Again, being Life Insurance Awareness Month, there are some important statistics of why you talk about life insurance with your clients. 4 in 10 adults, according to a 2011 survey, have no life insurance whatsoever. This isn't permanent insurance, this isn't term insurance, it's not individual coverage, it's not coverage through my work, none whatsoever. Almost 30% of people say they would feel the financial impact from the death of the primary wage earner in 1 month. Now I know that you're probably counseling your clients to have 3 months in an emergency fund, maybe even 6 months. So your clients probably would say 3 months. It's unlikely that at the death of the primary wage earner, there would be no financial impact felt. But for most families, and this probably has a lot of dual income households built into this, 30 days is how long a family could stay afloat without feeling that pinch. 35% of people surveyed in 2016 wish their spouse or partner had life insurance. So we know that 40% of people don't have it, 35% of people wish somebody else did. So there are a lot of people who are uninsured, underinsured. For your clients, many of them it may be more underinsured rather than uninsured. But statistics don't tell the whole story. So I want to talk about Tony. And I think Tony's particularly relevant to me because I remember working with Tony and his advisor, Michael, on the initial quotes and getting the policies in place back in 2013. Tony's a little bit older than me, but not really. Both had young kids. In 2013, Tony purchased a $3 million term layer. So $1 million, 15, 20, and 25-year term. 2015, end of 2015, end of last year, we got a call. And the call says, they're kind of those calls you hope that you don't get, and you sort of know what's behind it when an advisor calls and says, Mark, just want to make sure that Tony's life insurance policies are in place. We usually don't get those calls. And usually when you get that call, you know that something's happened. Maybe their health isn't as good. In this case, Tony died in a boating accident. And so his financial advisor, the family's financial advisor, Michael, called to make sure that those policies were in place. And we confirmed that day for him, Tony's widow, that the policies were paid and in force. The next day, we worked with the insurance company and got the claims forms and everything to Michael so that he could have them to meet with his client when they were going over all of this. And the claim has been paid actually in February. All of the documents were put together, and Tony's widow received the $3 million checks, $1 million checks. That's February 9th. So even though Tony wasn't in the picture anymore, his widow is working with a financial advisor to make sure that their family is going to be okay. Again, we can't protect against the loss, but we can protect against that financial loss. So if you have one of those stories that you can tell a client, a personal one, feel free to use Tony's story. Then your client is going to be saying, okay, I see why I need it. But like lots of different things, I get it, I understand it, I see I need it, maybe even I want it. But how much do I need? I don't even know where to start. Well, there are a few different ways that we can go about that. The first is what I call the rule of thumb. You can see that's a picture of a thumb ruling. Okay, I can hear people groaning. But the rule of thumb is a good place to start. The younger someone is, when we look at life insurance, particularly term insurance for income replacement, we're looking at how old they are and how many estimated years of income we need to replace. So for clients, late 20s, they maybe have 30 years of income ahead of them. And because life insurance comes income tax-free, we can use sort of around 30 years of income on a tax-free basis, probably equates to 35, the next 35 years of taxable income. It's a place to start. And you can see as we get older, we hopefully have fewer years of income to replace. And so when we get into our, start in our 50s, age 51, we still all think of retirement age as age 65, so 15 years of income is sort of, again, this rule of thumb. It's not a hard and fast rule. It's just designed to give us a good place to start. And this, again, this is an upper bounds. So if you have a client making $1 million a year, started a startup and she's 31 and makes $1 million a year, she probably doesn't need $25 million of life insurance for income replacement because milk costs the same for all of us. Gas costs the same. So this is sort of an upper bounds. You also have your financial planning software, which is probably the first place you're going to go. So this is just another option. And we've had advisors ask us before, I use my planning software, it gives me a number. It seems about right, but I don't really have a way to do a double check. And so we designed on our website the life insurance calculator. There's a few inputs. Again, it's designed to be sort of a, just something you can have a few inputs and give an idea, am I in the range with my financial planning software? Does it make sense? So we have your financial planning software, rule of thumb, insurance calculator, and then good old-fashioned common sense. Because we don't want clients worth a whole lot more dead than they are alive. Because then what happens? Then we have Alfred Hitchcock moments where people are driving down the hills and their brakes don't work. I'm silly, but that's the reason that there are things like those limits, that someone who makes $20,000 a year can't get $18 million of insurance, even though they could afford the premiums because term is so inexpensive. There has to be some justification. So if you're running the numbers, you're coming up with the planning, and you say, that just doesn't seem right, then it probably isn't. Feel free to give anyone here in our office a call to go over it if you have any questions. So we sort of check the numbers 2 or 3 different ways, 2 or 3 different places. So Homer's saying, okay, great, the amounts make sense for me. So we talked about my income, using all those different calculators about income. But what about for my work-at-home spouse? Everybody see what I did there? It's not stay-at-home spouse, it's work-at-home spouse. People who stay home and take care of kids work a lot harder than I do. I get to sit in a chair most days, for extended periods of time. I get to eat lunch. So it's really a work-at-home spouse. Because, and I love these studies every year, they come out to say, if you were to put together the number of hours that a work-at-home spouse does in different factors, there's one that's a professional IT consultant for fixing the computers, and chauffeur driving people around, and laundry operator, and all the different things that a work-at-home spouse is going to do. they'd have a base salary of about $48,000 a year, and because stay-at-home spouses, stay-at-home parents don't just do their 40 hours and then leave, they stay. So there's 52 hours of overtime. $143,000 is what the salary.com study says, that in order to hire all the people to do all the different things that a stay-at-home spouse / parent would do, that's $143,000 a year. No, of course, it's a little tongue-in-cheek, but however, if the stay-at-home parent, stay-at-home spouse happens to pass away, well then there is definitely a loss to the family unit, because that's something that, while that stay-at-home spouse parent isn't earning money, they're doing things to the family unit, for the family unit. And so there's definitely a financial loss if something were to happen to the spouse, because there would be other expenses that we'd have to hire people to do, childcare, other things, hire people to do so that we could, so that the employed spouse could continue to work and do all of their things. So Homer was wondering, how much coverage should my work-at-home spouse have? Well, Marge, she's that work-at-home spouse. Again, sort of a rule of thumb, most insurance companies will match the coverage on the employed spouse dollar for dollar up to $1 million. So if Homer, being employed, has $1 million of individual life insurance, then most insurance companies will consider Marge for up to $1 million of coverage. If Homer has 500, Marge can probably only be eligible for 500. If Homer's employed for $2 or $3 million, then sometimes we get into where the work-at-home spouse is eligible for 50% of what the employed spouse is. But again, sort of like my king thumb, these are general guidelines, and there's always the ability to justify additional coverage if there's an extreme loss to the family. So in the case of special needs children, that's definitely one where a stay-at-home or work-at-home parent has the ability to care for a special needs child, that maybe hiring somebody, if that stay-at-home parent wasn't there, work-at-home parent wasn't there, would be very expensive for someone who has the training and skills that you would need to replace that work-at-home parent. So I wanted to take a look at sort of where a scenario is that someone, again, work-at-home parent with no real discernible earned income can be insured for quite a bit of coverage. Mark and Laura have 2 children. They had some survivorship policies that weren't doing very well. They were variable. They were starting to sort of erode pretty quickly. And they designed a trust to provide the life insurance for their son. Their son, Zach, has, and I'm not sure if I'm pronouncing it right, Prader-Willi, but it's a disorder where someone basically will eat and never has that feeling of being full, and so it's a danger because they can actually injure themselves because they don't have that feeling of being full, and requires quite a bit of care. They'd actually been applying for state aid for Zach, so they're in the process of that, but Zach's very young, and so the cost of needing care, even with the government assistance, is going to be pretty high. And so they worked with their attorney and their financial advisor to create a special needs trust. And so they'd already done some planning for their daughter, differently than, of course, in the special needs trust. And so they were working on this special needs trust planning for Zach. They had those 2 survivorship policies already in place. So they'd applied for a new second to die life insurance policy. Second to die or survivorship policy being permanent life insurance policy that pays the death benefit at the second death, called second to die, survivorship. So actually, they'd applied, and what happened? Laura, or Mom, was approved at the preferred plus rate, the best class that's available. Mark, however, was issued at a table 5, so it's a substandard rate because of some heart issues. And so Laura had this, the best rate class approval that you can get. Mark's not so great. And what turned out is that by having the survivorship policy, because of Mark's rating, a policy covering both of their lives was going to have a higher premium than a policy that was just on Laura. So what ended up happening is that we asked if the policy could be issued on just Laura. Laura has no quote-unquote earned income. There is not a, there's no loss of income at Laura's death. But Laura, being the primary caregiver provider, ended up being approved for a $3.2 million policy on her life, which the advisor and the special needs attorney and everybody sort of came together and said this is about what we'd expect costs would be for quite a bit of period of time in case Laura wasn't there to be able to provide care. And in this scenario, it works. She will probably be the second to die. Not a true second to die policy, but the odds are that she will most likely be the second to die. Women tend to live longer than men of the same age. In this case, Laura also is younger, so she'll probably live a few more years, only 2 years younger, but she's also a super preferred where Mark wasn't. And so all of those different things give us a longer life expectancy assumption for Laura than we do for Mark. And so it's very likely that she is going to be the second to die anyway. So that's an example of how, depending on the circumstances, even though Laura really didn't have any earned income, the loss to the family unit was going to be significant if she wasn't there. Now, remember when I said that most insurance companies will match dollar for dollar? Many term insurance companies don't consider employer-provided group coverage as coverage when considering matching a spouse. And you say, why is that? Well, most group coverage, I don't really have to do anything to get. It just sort of is there. So the employed spouse, partner, didn't really do anything many times to get that coverage. Secondly, most group coverage only stays with the employed spouse while he or she is working at that employer. And so it may not be, permanent or, have much longevity to it. And so insurance companies are wondering why, they're looking at the risk to themselves to say the person who is making the income really didn't do much about life insurance. However, the person who has no income, they're looking to make effort to get life insurance on this person. And so many times it becomes difficult when trying to apply for coverage on a non-working spouse when the employed spouse only has their group coverage. Most of the time, group coverage isn't going to be enough anyway, and so applying for the individual coverage is going to help fix that issue. But again, how much coverage on an employed spouse or work-at-home spouse? Dollar for dollar of the employed spouse, up to $1 million. Again, rules of thumb, general guidelines, your financial planning software is going to give an idea too. But again, is it reasonable? Does it make sense? In this case, is someone worth a lot more dead than alive? If we come back to that conclusion again, it's probably too much life insurance. And then I have this question come up, not every day, but frequently. Mark, what do you think about life insurance on children? And, I will say that it's maybe not for everybody. I think sometimes people might have it on their kids and not even realize it. But for those of you who know the old story about the shoemaker and the shoemaker's children have no shoes, if I call myself a shoemaker, I'll tell you what my kids have, what shoes they have. And again, I am a life insurance person. It is what I do. And so my two children each have a $100,000 universal life policy. And they're low-load universal life policies, so they have low expenses, no surrender charges, high immediate cash values. And so the policy design is very flexible. And so what do I say? They could provide for health costs. Well, as they build up cash values, there may be money there available. But in the extreme, if something happened to one of my children and unfortunately passed away, they probably had some medical expenses. And so the death benefit of the life insurance can be used to help offset some of that. Final expenses, like a funeral. Lost income. It's not their lost income, but it's mine. I can, this is why this is hard to talk about life insurance sometimes, is because it's hard to even imagine a scenario where something happened to one of our kids. And, how long before I can think about going back to work? I'll have lost income. And so the life insurance on children covers some of those things because, again, there will be a real loss if something happened to one of my kids, whether it be the health expenses, paying for those final expenses, and more than likely, some lost income. Oh, and I had a question. How do food allergies affect life insurance on children? Most, depending on how old the children are, but usually juveniles under age 18 have very limited or simplified underwriting. There's no paramed exams. They're not going to take a blood draw or urine specimen. The children will be underwritten from medical records, the application. Food allergies, I think it just depends on the level of severity. And that's a good question. I don't know. I'd be happy to research that. The juvenile rate tends to be about the rate of sometimes maybe like a standard smoker rate because there's very limited underwriting. So unless it's severe and maybe have been hospitalized, things like that, I don't know that it would be a significant concern. All right, great. I love the questions. Thank you. Okay, so the life insurance on my children. What else does it do? Well, it protects their future insurability. That's a policy, like, again, they're assuming a standard smoker rate class. It's not the best available because they can't do the blood draw. They can't, get a lot of things. But no matter what happens to my kids later in life, they have that policy. If they're in good health later and they can improve on it, great. They can do something else with it. But in case they can't, this policy is there because people get diagnosed with horrible things. Again, this is why we don't like talking about this, because we can go to places where we think about this for ourselves or for our kids. But the reason it's there is because that's a policy that my kids, my son, my daughter, can keep forever. And to me, It's not a term policy. It's not a term need, because again, I'm looking that this policy may be needed possibly forever. If something were to happen catastrophically in their health in the near future, it may be the only life insurance policy they can ever get. And so the ability for permanent insurance to possibly increase if I overfund it, other things, riders that you can add to allow for the purchase of coverage later are, again, I think valuable that aren't available on term policies that are going to have a fixed period. Again, that's why I like the universal life. It's flexible. It also has the ability to overfund, underfund, skip a premium, take money out. Lots of flexibility with it. Okay, so let's talk next about having life insurance through work and having it individually. So many of your clients are like Homer. Great, I have life insurance at work. Woohoo! I don't need anything else. Wait, but I met with my financial advisor, and all of a sudden I'm thinking, do I really need more? Though Homer might have coverage at his current job at the power plant, he can't take it with him when he changes careers. And Homer's had lots of careers, whether it be Mr. Plow, an astronaut, garbage commissioner, or bodyguard for the mayor. Most of the time, group coverage or employer-provided coverage is fickle, and when he moves from career to career, the coverage stays behind with his last employer. So it can be a nice supplement, but many times there's only limited coverage, maybe 1, 2, 3 times salary. And I already said, for your younger clients, they may need 10, 15, 20 times income to replace the number of working years they have ahead of them for their young kids that work at home parent. With group coverage, the premiums are going to increase every 5 years. And what I'm talking about here is the coverage that your client pays for. There's usually one-time salary that the employer pays for. That's great. Maybe 2, maybe 3 times, so that somebody else pays for. I'm talking about the coverage that the client is actually paying for, the supplemental group coverage. And again, the coverage is good there while I'm working, but a generation ago, people started with an employer out of college or high school and stayed there for 40 or 50 years. Might be 2 generations ago now. The rest of us are going to change jobs. I think I read somewhere like 7 times before retirement. So the term coverage, the group coverage is great while I'm at the employer, but what if I change and decide to move from big company to startup, or current law firm to starting my own practice? I've left it all. So let's look at the process one of your clients took to get individual term life insurance outside of what his employer offered. Russell is 45, and his advisor recommended $2.5 million of 20-year term. And so he went online, did the online quote request, and it asked 5 questions. I said, great, spat out the quote. Well, you said no to the no questions and yes to the yes questions. You might be a super preferred. And so Russell was excited about that. He's thinking, that's fantastic, and I only had to answer 5 questions. Woohoo! This is easy. And the premium, $26.10 per year. But you can probably imagine that there's going to be more to this story, because that would be really, really short. And his advisor said, well, that looks good, but I'd like you to get a second opinion. I'd like you to call Mark. And call Mark he did, and we got what I consider real quotes based on more questions, more detailed questions. And found out that Russell told us that he'd had a small melanoma removed. Okay, well, that is, basically it's a skin cancer. Most insurance companies, none, are going to offer the super preferred rates with that kind of medical history. Most won't offer preferred. Most likely outcome, standard plus. So 2 notches below that super preferred rate he'd seen initially. And like I say, you can call me standard plus, you can call me a tuna sandwich, doesn't matter. What does it cost? In this case, instead of $26.10, it was going to, premium went up to $46.12.50 per year. Again, maybe not great. Nobody likes to see the cost go up. But the first quote really wasn't worth much. Wasn't worth the 30 seconds or 60 seconds that they'd put into it. So you're thinking, Mark, is that the final offer? Nope. Got even more. More to the story. So how did we get to the final offer? Well, after the application, after the paramed exam, after the insurance company reviewed his medical records, they said, we know that we were hoping for the standard plus at $46.12. However, the final offer, the actual offer, came back at standard rates. Because that small melanoma was actually 4 small melanomas. And the mild sleep apnea wasn't disclosed, with inconsistent CPAP usage. Annual premium $54.13 per year. So much closer to the standard plus, but still not as great. So what did we do? How did we work with the advisor and the client? Well, we ended up at the final offer with a twist. So instead of all $2.5 million of 20-year term, we layered some different term policies. So $750,000 each of 10, 15, and 20-year term. Combined brought the premium back down to about $4,300, about $1,000 less than the full $2.5 million for all 20 years. If any of you are doing the math, it's actually $2.25 million, so close with the layering approach. But for the first 10 years, he'll have the full $2.25 million of coverage. And then as time goes on, he gets closer to retirement age, term policies drop off as we have fewer years of income to replace. So we had the final offer with a twist. So working with the advisor and the client, got back to about the premium amount that Russell was thinking it should be. Again, call it a tuna sandwich, call it standard plus. Client sets up in their mind that the premium, I understand that $26.10 wasn't really a good number, but maybe that $4,300 range. So we can work with you and the client to do just this, to get back to where we thought we were going to be. And term layer, I'm sure some of you have heard me talk about it before. In this case, we used it at the end, after the policy had been approved, after it was time to put the policy in force. Many times we use a term layer design for the insurance coverage initially to do the same thing, to save premiums and tailor the coverage to the client, because it's tailoring it so that they have the most coverage today when it's needed the most. And the coverage decreases over time, because today, if something were to happen to Homer, he has the most working years ahead of him today than he ever will. And that's for us. That's for your clients. Today, they're really not ever going to have fewer working years ahead of them, or more working years ahead of them. Today is the day. So 10 years from now, I've worked for 10 years. I've saved for 10 years. I've paid 10 years off on my mortgage. So I'm closer to retirement. I am closer to my financial goals. I'm closer to that day where I say I don't need an income anymore. And so we can use the term layer approach to decrease coverage as the needs decrease. And the best part, every time one of those term layers drops off, so does the amount of money that the client is paying for the combined life insurance. So I'm getting closer to retirement, and my premiums for life insurance are going down. So there's even more money available to put into retirement to paying off debt. So far we've sort of, except for the exception of the children, talked about term. Term being for income replacement, term in the early years. So what happens at the end of the term period? Term is great, 10, 15, 20, even 30 years. It's a level premium. I know exactly what it's going to look like. But what happens at the end of the term period? Well, many times there's decisions to make. So the term is passed, and we hope the client didn't need the term. Kind of like we hoped with the homeowner's insurance that their house didn't burn down. But what if we get to Homer's next fear and we set up all those plans to say it's going to last for 20 years or 30 years. But what if I need insurance longer? I didn't quite make all of my goals. In 20 or 30 years, I'm 20 or 30 years older. Well, that usually doesn't mean that my health gets better. Usually, the older I get, the more likely I am that I have had cancer, that I have had a heart attack, that I have had those things come up in life. So am I insurable in the future? How insurable am I? Am I insurable at all? So what if I need the insurance longer and my fear is, what if I can't get it? Well, one thing we can do is we can convert. We can convert term to permanent coverage without any medical underwriting. Within the contract, I'll say that again, within a term contract, you have the ability without any medical underwriting to convert your term policy to permanent coverage with no medical underwriting. That's why it's valuable. So if we did all of our plans saying we only need the coverage for 20 years and things change and we need it longer and insurability is an issue in 20 years, we can exchange that term policy for permanent coverage. Even if today I'm uninsurable, but I was preferred non-smoker back 20 years ago, the new policy is issued at a preferred non-smoker rate. That's why conversion is important. And many times I think we think of conversion as when we get to the 30 years or when we get to be age 70. It's not a term need anymore. Now it's a permanent or legacy planning need. Term is not just for old people. Let's take Dino. He's age 47, and he had a $250,000 10-year term policy issued in 2006 at his age 37. Dino's 47, so guess what? We're coming up to the end of the term period. And that policy was issued 10 years ago at standard rates. Like I said, that term policy is expiring soon, but he doesn't need all $250,000 of the coverage he has. He only needs about $150,000. But he needs it for a new 15 or 20 years. So actually needs less coverage, but needs it a longer period of time. And as we talked about with insurability, based on his current health, if he were to apply for new coverage, he would be considered a Table D or substandard rate class. So, based on the premiums at the Table D, $150,000 15-year term policy, $1,300 a year, or $150,000 20-year term policy, almost $1,500 a year. But that term policy has the conversion privilege built into it. And what you note, you don't have to convert all of the term. In this case, with $250,000 policy, but he can convert just $150,000 at standard rates. Regardless of what his health is today, He can trade in his standard term policy for a standard universal life policy. And a premium of $959 per year is 27% less than what new term would be. And that guarantees the coverage for the next 15 years. And based on projections, it's projected to last 23 years. Remember, we needed it for 15 to 20 years? That's perfect. 27% less, keeps the minimum, may last longer. Lower premiums. Again, that is what this is. Lower premiums. Coverage, because his health has changed, he can get the same coverage at a much lower rate. Let's look at another life insurance need. In this case, Bob, he's age 70, lives in New Hampshire. He was a corporate attorney. He has a group universal life policy that his employer has been paying for him for a while. And Bob's been putting in some money too. Well, he's turning 71 next month and he's retiring. And what he found out is as soon as I retire, the employer contributions stop into this universal life policy. Well, I guess things could be worse because it is a $1.2 million policy that has $513,000 of cash value and a $410,000 cost basis. And as he's getting ready to retire, wrapping things up, cleaning off his desk, taking home the pictures of the kids, got some in-force illustrations, and so found one that said if he continues to pay $52.80 per year, it will keep that $1.249 million policy and will carry to his age 95. Option 2, he can stop all premiums, and that same $1.2 million policy is going to lapse at his age 90. Option 3, he can pay no more premiums, reduce the policy to about $1.12 million, and it will carry to his age 95. So Bob says, those are some good options. So talked with his advisor, said, Bob, those are 3 good options. Another 4th option is, well, you could surrender the policy completely and you'll get $553,000, but you're going to owe ordinary income tax on $103,000 of that. And Bob's saying, I sure don't want to do that this year because this was a good income earning year. It's my last year of income. It'd be great next year. I don't have any income, so I'm not wild about that today. I could keep paying the premiums, but it's not ideal. I like to leave some life insurance to my daughters, but it's not a huge thing. I prefer not to keep paying premiums. So maybe I'll reduce it, but maybe I want to get some money out too. So the first idea we had, working with Bob and his financial advisor, was to maximize the coverage with a low load, no lapse guarantee UL. And so the no lapse guarantee is a premium based policy that says for the cash values, the $553,000, it will guarantee almost $1.4 million of life insurance. So no future premiums, 24% more coverage than he has, and it's guaranteed for his lifetime instead of to age 95. So if the goal was to maximize the coverage, then that's a fantastic idea. Bob's idea, so we had option number 2, or idea number 2 as well. We could do the same thing, do the guaranteed universal life, guarantee the $1.4 million. But in year 2, take a tax-free withdrawal of his cost basis. And again, because we're using a low-load, no surrender charge policy, we can do that. We have the ability to take money out in the first or second, or in the second year. Most contracts are going to have surrender charges, and so you can't do that. You wouldn't have the ability to take the money out. But we could take out 400, Bob could, not we. It's not my money, it's Bob's money. Bob could take out $413,000 income tax-free and leave the remainder cash value in the policy that would have a $338,000 death benefit that would pass to his 2 daughters. And that would be guaranteed for life and no future premiums. So I think Bob's kind of like an idea number 2. Because he's going to get the $410,000 tax-free, and he's going to leave $338,000 as a death benefit legacy to his beneficiaries, 2 daughters, and they'll get it income tax-free. So idea number 2, I think Bob sure likes. Well, let's talk about claims, because we sort of led into that with Bob. Bob leaves the life insurance to his beneficiaries. How do his beneficiaries get the money? And Homer's asking that same question. Well, it's not quite as easy as going to the ATM and just taking it out, but there are some ways to get it out. You might feel like you win the lottery, but again, you aren't going to get it in those giant oversized checks. I have no idea how anybody actually cashes those. And some people are going to be better beneficiaries of life insurance policies than others. And I'm going to touch on that here in just a minute. But to process a death claim, what happens, and as we did a little bit with Michael and Tony, you notify the insurance company. That's the first thing that has to happen. And many times that's notifying us, LLIS, as the agent for the policies. Somehow, somewhere, the insurance company has to know that somebody's passed away. Many times that's, we can start a claim with a newspaper clipping. Not really newspaper clippings anymore, but obituaries online. So some of those things can start the process. For the formal process, then there's going to be an application, a death claim packet mailed to the beneficiary. One of the things that the insurance company is going to request is a certified copy of the death certificate. Just something in there to verify the claim and that it's been paid. If there's a trust, then copies of the trust pages that show who the trustee is, who can act on behalf of the trust to sign forms, collect the death benefit proceeds. When all that has happened and it's been approved, then there tend to be a few options or a few choices that have to be made. How does the beneficiary get the money? Well, they can take it in a lump sum. And again, it would be kind of cool if it was a bag of money that big as that guy standing there, but probably wired to an account wherever you may be working with your client and set it up to wire to account. But sometimes that's a hard decision to make. The beneficiary, whether it be a widow or widower, children, are dealing with a lot of things at that time. Funeral arrangements, trying to figure out all of these other pieces of things. So trying to figure out where it should go, how. Sometimes that's sort of a tough decision, which is why insurance companies have also come up with a direct access account. Basically, the life insurance proceeds sit in a savings account on hold with the insurance company, and the beneficiary gets a checkbook. So they can write checks to pay for funerals, to pay for flowers, to pay for Aunt Edna to fly in from Arizona, all of those things. So they have the ability to pay for immediate expenses right now, and then 2 months, 6 months, whenever it might be, figure out what to do with the rest of the money, wherever you're helping them make that determination. Or there are settlement options built into the life insurance contract. So when the claim has been approved and is ready to be paid, it can be a lump sum payment to the beneficiary, can do the direct access account that the beneficiary has the checkbook, or the life insurance can be paid out under one or more of these settlement options. Deposited interest. Basically, if it's $1 million policy, the $1 million is going to sit there and the interest gets paid to the beneficiary. Fixed installments. It's $1 million death benefit, and the beneficiary can say, I'd like to take my payments monthly over the next 10 years. So a fixed payment over the next 10 years. So that's an option. Life income options, and like an immediate annuity, some annuity policies. Pay me a guaranteed income stream over the rest of my life for as long as I live. And there's X dollars that will be paid to the beneficiary every month. All of those are options too that are built into a life insurance policy. I would assume probably that most people are going to take number 1 or number 2. But a neat thing about the settlement options, if you have a beneficiary who maybe is a spendthrift, who maybe not ideal to have a cash lump sum, you can build in to the policy that the payment that the beneficiary has to receive the proceeds as one of these settlement options. In effect, ruling from beyond the grave. I can set up my life insurance death benefit and the beneficiary statements so that my beneficiary can't get $1 million death benefit. It has to be paid out over a 10-year period or paid out over their lifetime. So that may be attractive if you have clients who their ultimate beneficiaries are not going to be good with a lump sum, and you're worried they'll get the life insurance proceeds and then you're having to bail them out of jail in Vegas. So it's just a neat thing built into policies that most people don't know are there. I don't know that most advisors know are there, but it's a neat thing that can be built into a policy to help protect the beneficiaries, really to protect them from themselves. So we talked about a lot of different things at Life Insurance Awareness Month. And if you want to hear more things about insurance, come to the XYPN conference in San Diego next week. I'm going to be presenting there. I'm also going to be talking at the NAFA conference in Arlington next month. Jerry and Jill are going to the ACP conference in Seattle. Right now, going to Seattle sounds really nice. Again, it's 90 some odd degrees out there. Sounds very nice. And we're going to have a Garrett member webinar in about 2 months. So lots of different places to hear more about insurance. And our registration isn't on our website yet, but we are doing our LLIS Academy in a new place next year. We are doing it at the Sheraton Sand Key on Clearwater Beach here in Florida, February 1st through 3rd, where financial plans meet sparkling sands. We've decided to do a beach theme. You as advisors have asked us, I'm going to be in Florida in February anyway, let's do it on the beach. And so we're planning to have we are having our Insurance Academy next year, February 1st through 3rd, 2017, on Clearwater Beach. I think I just saw something here recently that TripAdvisor ranked Clearwater Beach as one of the top 10 beaches in the world or country. So it's a beautiful place. For those of you who aren't familiar with LLIS, I just want to give you our top 10 things that make us different. The first are monthly webinars like this. We have 2 more this year, November and December, to listen to us talk about tips, ideas, thoughts about insurance for your clients. We're not your competition. Our only clients are fee-only financial advisors, and we work hard to save you time and your clients money with designing life insurance policies and helping get from that initial quote or thought process to policies to being insured and covered. We do a lot of pre-underwriting to avoid surprises. We provide a lot of tools for you and your clients on our website. And we are very proud sponsors of a number of different fee-only financial advisor groups. Again, we couldn't do what we do if it wasn't for you, so we are proud sponsors every year of all the fee-only advisory groups. We have specialists here in our office in life, disability, long-term care, annuities, and the long-term care hybrids. So long-term care policies built on a life insurance chassis or an annuity chassis. And we keep you as the advisor in the loop using our AIM system, our application information message. So you're kept up to date as your clients are proceeding through the quoting, the application process. And we're here to work with you in the long term. So we're helping you and your clients keep those policies in place because they spent time getting them in place. You recommended them. It's important to keep them. Insurance policies aren't any good if they don't exist, so it's important to keep them. And we've built systems with our APE, advanced premium emails, and notice of term expiration for those conversion times when a client maybe does need coverage longer and they can't get coverage anywhere else. I want to say thank you all again very much for attending. It is September. Still looks kind of like that here in Florida. It is still hot. But I can't wait to see many of you at the XYPN conference just next week. And I hope all of you safe travels. I will see a number of you. Yes, I will see a number of you at the NAFA conference here in just over a month too. I'm hoping it's going to be cooler then. So everybody have a great evening. Thank you all very much.